So I believe it's time to get some appetizing set of insights from none other than Siddharth Srivastava. So I'm going to request everyone to please be seated as I invite on stage Mr. Siddharth to share his thoughts around how ETFs really work and, most importantly, where are the opportunities. Could you please put your hands together, ladies and gentlemen? Please help me welcome on stage Mr. Siddharth Srivastava.
So I think after a very insightful session, I think my presentation is going to be a bit technical in nature, so please bear with me. First of all, good morning, and it's great to see you all in person after such a long time. And I'm here to present on how ETF works and what are the opportunities. Now, let's first understand who are the key players when it comes to ETF. Unlike active funds, where typically your investment team and the fund managers are the key decision makers about which stocks to buy and sell, and hence affect the performance of the scheme. In case of ETF, the index provider is the heart and soul because they decide the methodology on how the portfolio selection will work, and then they launch the index. And this indices can be based on a broad market like Nifty 50, a theme like consumption, manufacturing, or a strategy like momentum and low volatility. And they are the key reasons why so much innovation is taking place in the ETF industry. Probably the second most important participant is authorized participant, and I'll come to that later. But after the index is created by the index provider, AMC is the one which productize it and then manage the ETF. Ultimately, AMC's role is solely to track the index because since we are talking about passive investment vehicle whose only objective is to give you returns corresponding or similar to the returns of the underlying index. So we as a fund manager or people who manage the ETF, our role is to simply replicate what index does in order to provide the similar performance. Then one of the most important player is authorized participant. And probably these are the one about whom there's very less information in the market. And they are very key to the retail investors because what they do is they buy units from the AMC and they provide both bid and ask quotation in the market. In order to do that, they always try to identify what is the real-time net asset value of the ETF unit. So unlike an index fund or a mutual fund, where you only transact based on day close NAV, in case of ETF, you can buy and sell during the market hours based on prices around the real-time net asset value. And these are the key players who first ensure the liquidity and secondly ensure that the prices are always around that mark. And probably if ETF has to grow in retail, then they have to basically evolve more. And lastly, exchange, where you can simply buy and sell ETF just like stocks. Now let's see how ETF works. There is an index. I've taken a very simple example. Let's say index consists of HDFC, Reliance, TCS, Infosys in these weightages. Now, as I mentioned earlier, the role of ETF manufacturers like us is to simply replicate the index, buy all these stocks which are forming part of the index in the exact same proportion. Now I'm talking about full replication here. Recently, because of target maturity debt index funds and ETFs, SEBI has allowed risk replication where you don't need to replicate the entire portfolio, but let's stick to the full replication in this example. So the ETF portfolio will buy HDFC, Reliance, TCS, Infosys, and other stocks in the same weightages, and there'll be some residual cash component. Now here things get a bit technical, and it is technical at our end, it is not that technical at the investor end. So what do we do is on an ongoing basis, we always create fresh units of ETF in creation unit size. And we always redeem ETF units in again creation unit size. What is creation unit size? Creation unit size is simply a quantum with which we can faithfully replicate the underlying index. For example, in case of Nifty 50, if we talk about mirror asset, then our creation unit is around 82 lakh rupees. So with 82 lakh rupees, I can deploy money in all 50 stocks of Nifty 50 and have a roughly similar weightages in the portfolio. And we do that, ETF manufacturers do that, so that any time the quantum is deployed or quantum is redeemed, it is always in the proportion and reflects the underlying component of the index. Now, the large investors, like institutional investors or HNIs or authorized participant, can come directly to the AMC and buy and sell in multiples of creation unit size. And this is where we are seeing ETF has evolved tremendously, right? A lot of investors like EPFO comes to AMC directly and buy and sell in creation unit size. Now, what is done next to improve the liquidity and allow ETF to trade on exchange is that these creation unit, for example, I said that our Nifty 50 ETF is around 82 lakhs basket size, is broken down into smaller ETF units. In our case, one creation unit is representative of 50,000 units. So each of these units roughly represents a price of around 164 in my example. So these units are then purchased by authorized participants and they provide bid and ask quotation on the exchange. They, in a way, work like a bank in a forex market. Suppose you go to HDFC Bank branch and you want to buy US dollars. They provide the US dollars with some spread. And if you want to sell US dollar, you again go to a same branch and they will buy US dollars from you, again charging some spread. Similarly, authorized participant will buy and sell these ETF units from the investors around the real-time net asset value after charging some spread. Now, hence, there are two ways to buy and sell ETFs. One is obviously transact on exchange. It's really simple. Investor needs to obviously use his broking platform, go on the stock exchange, and buy and sell ETF units, just like stocks. It's that simple. And he or she can purchase as small as 1 unit or as large as a lakh unit, depending on the liquidity of the ETF. Again, the price here is controlled or in a way managed by the authorized participant. So authorized participant plays a very key role to ensure that ETF units are trading around the real-time net asset value. The second is obviously, as I mentioned earlier, that a large investor can come directly to the AMC and buy and sell in multiples of creation unit size. Here also, the value which he will realize is dependent on the value at which AMC is either creating the fresh basket or redeeming the existing basket. So whatever is the realized value is the value which large investor will pay or will get in case of redemption. Now let's get a bit technical. That was about how transactions take place and how replication take place. Now let's talk about what happens during the life cycle of the ETF and why people should also focus on this. So as I mentioned that AMC's role is only to replicate the index. And while the segment is called passive, the index is not passive at all. A Nifty 50 index, the constituents, you see a churn of almost 5 constituents per year. In case of alpha index, you see a churn of more than 100% in a year. In case of low volatility index, you will see a churn of almost 30 to 40% per year. So portfolio keeps on evolving. It may be due to rebalancing, which happens in a set interval, maybe quarterly or semi-annually or annually, or because of ad hoc reasons. Now, hence the first job is to replicate the index. As soon as there is a change taking place in the index, the ETF needs to be change immediately. For example, if today, end of day, one stock is moving out of Nifty 50, the ETF will also sell that particular stock today itself in order to have a low tracking error. Now, what is tracking error and tracking difference? Because this particular parameter gets talked about a lot these days. So tracking error and tracking difference simply tells you how well ETF is tracking the index. And unlike what a lot of people believe, it has nothing to do with the market prices. Basically, the tracking difference and tracking error is computed based on the NAV, which is declared by the AMC. So it has nothing to do with how well ETF is moving on NSE and BSE. Rather, it is to do with what the NAV is being calculated by the AMC at the end of the day and how well that is replicating the underlying index. Now, let's take one example. In case of this graph, the orange line represents the index. And then we have taken three set of schemes: Scheme A, Scheme B, and Scheme C. Now, tracking error is basically, in terms of maths, standard deviation of daily difference of returns of ETF and the index. For example, if today the index gave a return of 2%, whereas the ETF gave a return of 1.9%, there's a difference of 0.1%. So this difference is deduced on a daily basis, and then the standard deviation of same is taken. So tracking error, in a very simple nutshell, tells you how well ETF is tracking the index on a daily basis, how well it is tracking its movement. So here you can see Scheme C, which is denoted in green, is actually moving almost in sync with the index, which is denoted in orange. Scheme A, you can see on particular days like day 4, it had lesser dip, and hence it is not tracking the index as faithfully. And Scheme B, again on day 5, moved less than the index, and again it is not replicating the index faithfully. So in a very simple example, Scheme C has the lower tracking error because the movement of Scheme C is similar to the movement of index. Now, does it mean that Scheme C will also have a better, higher tracking difference or a lower tracking difference? The answer is depends, maybe. For example, Scheme A, instead of having a higher tracking error, is able to generate a better performance. And that can be due to several reasons. For example, the Scheme A didn't deploy the portfolio completely. There was a cash portion in the portfolio and market fell. And that is why Scheme was able to generate a better return. But that is not something which people should go by. They should always look at tracking error. Scheme A and Scheme B, which gave returns which is different from the index, either on the higher side or on the lower side, simply suggests that these schemes are not tracking the index properly. And hence, probably, the tracking error should be the main parameter based on which the ETF performance should be judged. Now, one thing which is also asked typically is that what should be the tracking error of a particular scheme. Now, again, it depends on what sort of index the ETF is replicating. If you're talking about Nifty 50, anything below 5 basis point is very good. 0.05% of tracking error on an annual basis is very good. If you're talking about mid cap, it goes into 10, 12, 15 basis point, higher double digit. If you're talking about probably small cap, which we don't have in India as of now on the ETF side, again, the tracking error will be on the higher side. If you talk about international equities, it will again be much more. The reason is tracking error will be low if the underlying portfolio is replicable. Underlying stocks are liquid enough, and we know Nifty 50 consists of liquid stocks, large cap stocks. Any changes in the index can easily be replicated by the ETF, and that is why the tracking error is low. But in case of, let's say, a small cap ETF, whenever it is launched, probably the underlying portfolio is not that liquid. Probably you cannot make the changes in the portfolio as and when the index is making changes in the portfolio. There's an issue of upper circuit and lower circuit. You probably are not able to sell stocks if a circuit is hit. And those are the various reasons why tracking error is different from one segment to another segment. And still it is then becomes important to compare your one ETF product with its peer only. For example, a mid-cap should typically be compared with a mid-cap ETF, and a Nifty 50 should be ideally compared with a Nifty 50 ETF from a tracking error point of view. I'll probably skip this. Now, let's look at ETF market growth, and then we'll talk about what is driving this growth, and then what are the opportunities. Now, in India, ETF market has obviously grown tremendously, and that is why we are having these conferences to talk about this, this investment avenue. If you look in April 2016, the overall AUM was just 21,000 crores. And right now, as of close of April 2022, it is 4.3 lakh crores. It has grown at a CAGR of 53% per annum in last 5 years. So the growth is very good, and that is also reflected if you look on the right side of the table and see the number of retail investors and corporate investors who have grown. If you look at March 22 numbers, right now the retail investors are around 1.45 CR. Whereas 2 years back, they were around only 23 lakhs. So there's a significant number of growth in retail investors. Even on the corporate side, if you look in March 22, again, 53,000 investors roughly, whereas 2 years back, it had only 27,000 investors. So not only AUM is increasing, but also number of investors are also increasing. So while the majority of AUM has been because of EPFO contribution in Nifty 50 and Sensex ETF. But if you look in detail, you'll find that there's an undercurrent which is making more and more retail investors and corporates to explore the ETF. And we'll now talk about what are those reasons which is driving this change. So two most important factors which is leading this change is the performance and the cost. Now, as markets become more efficient, and we have seen that in developed markets, these active fund managers typically starts facing challenges in order to generate alpha. For example, what we have done in the first table, we have compared Nifty 50 index, Next 50, and Midcap 150 with the MF schemes. And what we see here is that Nifty 50 index outperformed 96% of large cap mutual funds by an average of 3.1% in last 5 years. Even if we are looking at a 7-year data, we are looking at a quantum of 88% of funds underperforming the index by an average of 1.8%. Even in Nifty Next 50, we are talking about numbers like in last 1 year, 100% of outperformance by an average margin of 9.7%. And again, in 7-year and 10-year period, very healthy figure of around 100% with an average outperformance margin of 2.7 to 3%. Now we are also seeing this phenomena in mid-cap segment also. In last 1 year, when market had a bull run, you're talking about 64% of schemes underperforming the mid-cap 150 index by a margin of 1.2%. And people have started to notice it. People are realizing that in broader markets especially, it is becoming very difficult to generate alpha on a consistent basis. In fact, we are looking at one data in regular plan. There was not even a single active mutual fund scheme which outperformed Nifty 50 in all of the last 5 calendar years. In fact, there was just one scheme which outperformed the benchmark in 4 out of 5 calendar years. So not only the underperformance is an issue, but also consistency of few of the funds which are generating alpha is an issue, and people are obviously noticing this, and that is one factor which is driving people to invest in, at least in broader simpler ETFs like Nifty 50, Next 50, etc. Now, second is obviously cost. If you're seeing a large cap active fund typically at an average cost of 2.2% and a direct plan at a cost of 1.1%, not outperforming an ETF, let's say a Nifty 50 ETF, which is available at around 7 basis point of cost or 8 basis point of cost, the cost becomes the point of discussion. For example, if someone would have invested 10 lakh rupees and that would have grown on an average by, let's say, 11% per annum over 10 years with similar portfolio returns, a Nifty 50 ETF would have generated 25.4 lakh compared to a direct plan which would have generated 23.36 lakh compared to a regular plan of large cap fund which would have generated 21.3 lakh. And that is what, again, post-performance cost also becomes a factor. Now, one very interesting thing is that ETF is also, or rather passive is also now talked about from an innovation point of view. We are seeing plethora of products being launched with different strategies, different themes, and that makes things interesting, right? You then have products which can be invested from a core portfolio, core allocation point of view, and then you have products where you can explore from a satellite allocation point of view. So the first bracket talks about the AUM, the second bracket talks about the number of schemes. So you have broad market schemes which have been there since a really long time and have been seeing consistent inflows. Then you are seeing rise of debt through target maturity ETFs and funds. You're also seeing gold and silver obviously gaining decent amount of AUM. But one very interesting thing which is happening is the rise of other ETFs also in themes, in sectors, in smart beta category. You should look at probably the inflows which is there in momentum and low volatility to see how differentiated these products are and how willing people are now to explore these products. For example, in this volatile scenario, perhaps people will be more keen to explore low volatility ETF, right? And that is one option which is there on the ETF side. It is not there on the active side. Something like Next 50, if you look at any large cap fund or any flexi cap fund, you'll find it biased towards the large cap stocks which are forming part of Nifty 50, but typically you'll find underrepresentation of Nifty Next 50. And then again, you have index funds and ETFs through which you can take these focused route to take exposure in those Next 50 stocks. Similarly, in international, you can invest in US market, Hong Kong market, and that is one very interesting thing which ETFs and index funds are providing. So it's not about a question of or whether active is better or passive is better. We believe that at least for the future, the better way is to think active and passive. There are obviously active funds which are doing really well, which will create wealth in the long term. There are segments of the market where active makes much more sense, but we should also accept the fact that there are segments of the market where passive is also doing well, especially in large cap category. And then there are segments of the market where options in active itself is not available. As I mentioned, in smart beta category, in international exposure, in few of the themes. And then again, there passive becomes an option because active doesn't exist. Now I'll take 2 more minutes. The first table simply allows that how well we can do by simply combining the power of active and passive. For example, in last 5 years, average returns of large cap funds, and this is again regular plan, was around 11.3% and portfolio TER was around 2.2%. Nifty 50 index gave a return of 14.3% with a roughly TER of around 10 basis point. If you simply do an allocation of 30% in Nifty 50, your 5-year returns improve to 12.2%. Your overall portfolio cost reduced from 2.2% to 1.6%, and you also generate a better return to risk ratio. Again, that was one example of core allocation where a product like Nifty 50 or a Sensex or a Nifty 100 can become part of your core portfolio. But let's talk about satellite allocation also. In the second example, what we have done is we have simply added S&P 500 top 50 as a satellite allocation. Let's say in the last line, we have given 20% allocation to Nifty 50 and 10% allocation to S&P 500 top 50. Again, the returns improved to 12.7%. Your return to risk ratio also improved to 0.69, and your portfolio TER again from 2.2 to 1.6%. So you are not only providing diversification, you are basically doing portfolio completion because you are choosing some ETFs for core allocation, benefiting from the lower cost, and then you're choosing some ETFs to complete the portfolio and provide exposure which is not available on the active side. Now, this was the study which was done by Greenwich Associates a while back among the institutional investors. And what they found was how institutional investors globally use ETF. 72% of them use it for tactical adjustment. Based on the short-term views, they can use thematic sector or smart beta indices or ETFs to take a very short-term call. For example, someone can invest in low-vol ETF right now. 68% do core allocation, similar to what Nifty 50 and Sensex. 60% use it for rebalancing purposes. For example, you right now don't have a view on where the market is headed. You can park the money in a liquid ETF, or if you want to take a market call, you can simply invest in a Nifty 50 or a Nifty 100 and ensure that there's no cash drag in your portfolio. 57% of them use it for portfolio completion. For example, again, as I mentioned, that Nifty Next 50 is not well represented in the active side. You can use Nifty Next 50 for portfolio completion. If you don't have an international exposure, you can use a NASDAQ 100 ETF or a FANG Plus ETF for portfolio completion. And lastly, the international diversification, which typically people prefer to use ETF because you don't want a fund manager risk, but still you want a market exposure in your portfolio. I think I've overshot the time, so I'll just quickly wrap this up. So those are for the opportunities which are there in the ETF on the passive side, but we should also be aware about the challenges. What are the challenges? The main challenge right now is to ensure that you are buying and selling at the right price. Unlike index funds or active mutual funds, which can be purchased or which are purchased at the day close NAV, here you can buy and sell ETFs at the intraday net asset value. So while transacting, you have to be sure that your transaction price is around the INAV. And you can simply go to any large AMC website. Each of us display the INAV on a regular basis. Just cross-check that and then place the order so that you are sure that you are buying and selling at the right price. I think that one education is needed for ETF industry to grow more on the retail side. Secondly, not all ETFs are equal. Index drives the performance. A simple example will be just look at low vol product which is developed by different index providers. Based on the different methodology, you'll find a different portfolio. And it is important to understand how portfolio is created so that you understand the risk profile of the index as well as the ETF, and then you take a conscious call on whether to invest or not to invest. And then choosing right options. We are seeing that within Nifty 50 also there are 18 ETFs. You should probably look at liquidity, you should probably look at tracking error and cost while choosing the right product. Because it is also important to note that while ETF may remove active risk associated with fund management, but it does not remove the market risk. So depending on how the portfolio is created, the risk which investor is facing will change, but risk will be there. So it is very important to understand what is suited for the investor. So that's it from me. Thank you for patient listening, and thank you Cafe Mutual for organizing this event.